My name is Michael King. In this second video on financial forecasting, we're continuing the percentage of sales method. In the first video, we gave an overview and talked about the first two steps, deciding key assumptions and forecasting the income statement. In this video, we're going to forecast the working capital, which is necessary to build our balance sheet. We're then going to forecast our entire balance sheet using cash as a plug, and we're going to confirm that by checking it against the statement of cash flows, which we're going to forecast as well. And having built our three financial statements, we'll calculate financial ratios, see how they look, and check the sensitivity of our forecast. The next step to building our balance sheet is going to be forecasting working capital. And here we're specifically focused on days of accounts receivable, days of inventory, and days of accounts payable. We have to make an assumption about each of those, as well as other current assets and current liabilities, which are not shown here. As you can see, they're going to be linked to either sales or cost of goods sold. So once we know the days of receivables, for example, if the days of receivable in year 0 was 25, we would divide sales of 100 million by 365 and multiply it by 25 days. That would tell us what our accounts receivable would be here, 6.8 million. Similarly, if days of inventory, we had 90 days of inventory, well, based on cost of goods sold on a typical day, we would have 17.3 million would be 90 days of inventory. And lastly, days of accounts payable. If we take 45 days to pay our suppliers, we look at COGS on a typical day, COGS divided by 365, and you can back out, based on 45 days, what the accounts payable would be, 8.6 million. We do this for each period. Notice that they increase, the working capital accounts will go up with sales, which makes sense, because as you increase sales, you have to invest more in working capital. With these three items, we've got key items we need for the balance sheet. Once we have that, we can start forecasting the rest of the balance sheet. We have debt and working capital. We can forecast the rest. We're going to leave cash empty for now. We're going to use our estimates of CAPEX as a percentage of sales, and we're going to look at our depreciation and amortization to determine what our fixed assets are. Remember that PP&E, or property, plant, and equipment, is going to be the starting value, adding CAPEX, and subtracting depreciation that year to get the end value. To get shareholders' equity, we're simply looking at the starting shareholders' equity plus any retained earnings to get ending shareholders' equity, and this assumes that there's not going to be any new equity issuance or share repurchases. We will be able to check this later in sensitivity if we like. Notice again that we have the balance sheet. Here in red we see that cash is the plug, and it's not known yet for periods 1 through 5, but we're able to fill in the other accounts, our working capital accounts, our PP&E, our total debt, which is 100 million but unchanged, and our common equity. We assumed it started at 500 million and that it goes up by the amount of retained earnings each period. Notice that we're able to calculate total liabilities and shareholder equity for each period now. We should be able to calculate total assets as well. How? For a balance sheet to balance, assets must equal liabilities and shareholders' equity. If we know liabilities and shareholders' equity, we can set assets equal to that. Now we have only one unknown, which is the cash plug. Once we've calculated total assets, we have the other categories. We can simply back out what cash must be in order to set total assets equal to that amount. Here you can see the plug shows cash going up from 84.5 million in year 0 up to 112.8 million in year 5. We could have used a statement of cash flows to determine the quantity of cash available at the end of each period, knowing that end cash is equal to starting cash plus any change, where the change is simply cash from operations plus cash from investing plus cash from financing. Notice that cash is increasing in this example, which is based on these assumptions. That will not always be the case. Often we will see cash declining, which signals that the company needs to raise external financing, either by increasing debt or by issuing common equity. If you do get a circular cell reference error, which can happen in Excel, typically you would find that the problem is somewhere in one of these areas. It's either somewhere in your working capital, in your interest expense or your quantity of debt. Maybe you calculated fixed assets wrong, or maybe you forgot to add retained earnings to your common equity, or you could have just forgotten to deduct dividends as a use of cash. Here we can see the statement of cash flows built up from net income plus depreciation plus the increase in accounts payable less increase in accounts receivable and inventory gives us our cash from operations. Notice that in this simple example, the only cash from investing is an outflow for capital expenditures. When it comes to cash from financing, we have no change in debt, and we're paying out cash in the form of dividends. When we start with the starting cash flow, look at those three items, we can see that the end cash flow is going to match our cash at the end of the year on the balance sheet. Cash will increase when these things happen. The company has positive net income, working capital is going down in general, long-term assets are sold, or equity or debt are increasing. Cash will decrease when the opposite occurs, when the company has losses, when working capital is growing, when long-term assets are being purchased, and when equity or debt are actually being paid down. Once you've got your forecast of your three financial statements, you want to check how they look by looking at financial ratios. You should be looking at the trend over time versus history to make sure it looks reasonable. Here, for example, cash as a percentage of assets is going from 14% of assets to 17%. You can see that as a result of the rise in cash, the current ratio and the quick ratio are both improving. When it comes to financial leverage, we saw that debt was staying stable. So not surprisingly, the EBIT to interest coverage ratio is improving, and debt as a percentage of assets or shareholders' equity or capitalization is declining. Profitability here was not very high in terms of ROE or ROA. That's based on our assumptions. You could have done a DuPont decomposition to see what is the cause. It appears to be here very low asset turnover, as well as a low net profit margin and modest financial leverage. Notice also that the sustainable growth rate, which is ROE times 1 minus the dividend payout ratio, it does seem to be matching up with the long-term growth rate of sales of around 2% in the fifth period. That's it. Good luck with building your financial forecasts.